Limited company or sole trader side hustle edition. Let me draw it for you. So at the minute, this is what we call the tax stack. So this is your income. And if we set up the side here, that's 70,000, 60,000, 50,000 and downwards. What happens at the moment is that your job income, let's presume you're earning about 40K. So let's say it's about here. At the moment, all this income here for your job, that's actually taxed at 20% in there as your job income, which is fine. And anything up to around 50K is 20%. So when it comes to deciding whether a limited company is going to be better or not, you've got to think about what happens after the 50K. So what could happen here is we've got £10,000 between 40K and 50K, where that's also 20% at the moment. So this bit's still quite nice. It's still fairly cheap tax. But what happens is if we go above that line and we end up out here, this is going to be 40%. And we've got national insurance to consider as well here. So this is 40 and this is 20 in here still. This is where it starts to get expensive. So if our sole trade income was actually a fact that we were going to earn another £20,000 in sole trade income, we'd have some there at 40% and we'd have some at 20. So we might be paying, for example, about £4,000 of tax on this one and about £2,000 in tax here. So we've got a £6,000 tax bill on this £20,000 sole trade income if we were going to be in this situation. Now, what you might decide, for example, is that if you were going to create a limited company, what tends to happen then is we split it. So what happens is here, if we've still got you here, so nothing's changed. You're still here. You've still got your job income. What you are able then to do is your limited company's over here. So if your limited company starts earning its own income, what's going to happen is let's take that £20,000 now, and limited companies for £20,000 profit at the time recording this video only pay 19%. So we actually only got a tax bill of 3,800 versus the 6,000 before, which leaves us with about 16 and a bit that we could take out. Now we're not taxed again unless we want to touch this. So if we wanted to take some of this money out, we could actually, if we are 50K lines here, we've still got that £10,000 we were talking about. We could take out what's known as basic rate dividends, which is the profit. And that can come out at 8.75. So that's still pretty tax efficient. But on top of this, we could do other crazy stuff. Like if we really didn't want to do that, what we could actually do is have our company pay into our pension for us. So if we didn't need this money, we could pay all of it into our pension scheme. Now, subject to a few different rules, but let's just keep it straightforward for now. It means you've actually earned no taxable profit, no tax bill, and it's not touched your income. So sometimes you can see it's obvious, and it's actually better to have a limited company so that we don't pay this 40% tax. If we don't need the money, and that's a key thing in this example, if we don't need the money, there's a lot better ways of kind of shielding it in the limited company and deciding to either drip feed it out to ourselves in dividends, maybe over a couple of years, we could pay it into our pension, or we could do other things with it in the limited company. So if this is you and you've got this higher rate tax problem, this 40% tax problem, a limited company might well be worth investigating.